But this is what happens when you manipulate markets for 8 years. When you have this much intervention, this much money printing, when you distort price signals this much, you're in a what we call in the intelligence community the wilderness of mirrors. Like you just don't know where you are, and that's kind of where the central bank is today. They took the stock market down by raising rates, and then they took it back up again with forward guidance and happy talk. So to me, the stock market is not a particularly valuable indicator because I can see it's being manipulated by the Fed. So I would draw a straight line between the Fed's rate hike and the market drawdown. So what I see coming is an exact replay. They're going to
Yeah.
raise rates in December. They're going to sink the stock market. They say they don't care. By the way, I had the same conversation with Bernanke a little bit earlier. He said a very interesting thing. He also said they don't care if the stock market goes down, but he said till it's 15%. What it means is that, 5, 10, maybe even 15%, they're like, too bad. We told you we were going to do it. If you're like leveraged up in stocks, that's on you. It's not our job to prop up the stock market. And that's probably true to an extent. But beyond a certain point, when it falls too far, too fast, it becomes what they call disorderly. Then they worry about contagion. Then they worry about, oh, is this going to spread to banking? Is it going to spread to money markets? Is it, et cetera? Is it going to be a replay of 2008? Then they do intervene. And that's what they were looking at last February. But, from January 1st to February 10th, it went down 11%.
Yeah.
And that was like a 5-week period from start to finish. Most of Wall Street, it's not just hedge funds. Some of the hedge funds are on the wrong track here. Not all of them, but some of them are. But more importantly, the Wall Street firms, the major banks, JP Morgan and others, and the regulators and the central banks, the Fed and ECB, et cetera, they have all got these models wrong. They're all using variations of value at risk. There are some assumptions underlying value at risk. When you test those assumptions, they assume, efficient markets, that markets incorporate all information smoothly and that the price of any market, represents all the information known. You can't beat the market because you don't have more information than the market itself. When you actually look at the science, every one of those assumptions is wrong. Markets are not efficient. There are all kinds of inefficiencies. There are big ones right now. We saw it in Brexit around the U.S. presidential election, massive mispricings that based on a kind of more analytic assessment of potential outcomes. People are not rational. But why people cling to it, why they stick with it in the face of a lot of contradictory evidence, part of it, there are two main reasons for that. One is simple academic inertia. You're a 60-year-old professor and you've got a 28-year-old PhD candidate, and that PhD candidate comes to you and says, Professor, I'd like you to be my thesis advisor on this complexity project I'm working on. Says, it's completely at odds with everything you've been doing for the last 50 years ago. You crazy, get out of here. You'll never get published. You'll never get a faculty appointment. You'll never be in any prominent journals, because you're challenging the orthodoxy. Likewise, on Wall Street, there's a lot of bad motivation because value at risk, for all its flaws, does at least superficially allow you to take more leverage than you really should. It allows you to take a lot more risk because it tells you the risk isn't there. There's enormous risk in these positions, but value at risk says there isn't. So if the regulators are willing to accept it, which they are, you can use more leverage. You can get big profits, pay yourself a big bonus. And if the whole world collapses, next year, who cares? I got my $10 million bonus this year. Probably, take the money and, buy gold or land or something that's going to last. And if the whole world collapses, well, too bad for them. I mean, that sadly is the attitude of a lot of hedge fund people and Wall Street participants, particularly if they can trade with other people's money. Kind of a heads I win, tails you lose type of bet. So between simple inertia, the inability of people or willingness of people to grasp new ideas, self-interest in terms of preferring a system that may be statistically invalid but enriches you personally at the expense of others, these are all bad reasons for why this stuff persists. I say every lesson we needed to know, every lesson we needed to learn to avoid 2008 was right there in 1998 after long-term capital. And not only did we not learn the lessons, we did the exact opposite. If you laid out here 5 things we should have done, we did the opposite of everyone. We repealed Glass-Steagall so that commercial banks could get into investment banking and act like hedge funds. We repealed swaps regulations so that everybody could use more leverage, hidden leverage, off-balance sheet leverage. We repealed certain aspects of the broker-dealer capital rules so broker-dealers could effectively leverage 30 to 1 instead of 15 to 1, et cetera, on down the list. There's something called Goodhart's Law, named after an economist, Charles Goodhart. When a market indicator becomes the subject of policy, it loses its meaning as an indicator. In other words, you take economic data, you treat them as signals, whether they're market prices or GDP or unemployment or inflation or any of the things that people look at. and you use them as information, and you do exactly the kind of analysis you just described. Well, unemployment's low and it's not getting lower. Is that a sign of a top? And historically, that may be perfectly valid and a good insight. The problem is that so many of these indicators have become the targets of policy and they are manipulated that they've lost their value as information. A simple one would be Chinese GDP. You look at Chinese GDP, it moves 10, 11%. Then it kind of came down to 9%, 8%. Now it's below 7%. But the government is targeting 6.7%. They said, we're targeting 6.7%. Well, you know what? If you target GDP, you can make it whatever you want. All you have to do is go out and build a $5 billion train station in a town with 100 people, right? So, glass and steel and architects' fees and cement and engineering and worker salaries. If you build a $5 billion train station, that's $5 billion of GDP. You can make your GDP whatever you want. But it's a complete waste of money. If you put a $5 billion train station in a small town, more people are not going to take the train. They're certainly not going to pay more for their tickets. Like you can do smart things. You can build a highway and put a toll booth on it, and people use the highway and collect the tolls. There is smart infrastructure. I'm not against all government spending, and I'm not against infrastructure, but you do have to be smart about it. But my point with regard to China is quite often they're not smart about it. They're just hitting targets. And so when I look at inflation, when I look at interest rates, when I look at unemployment, when I look at GDP, I say to myself, how many of these things are now subject to Goodhart's law? How many of them have become targets of policy pursued through manipulation and market intervention so that they've now lost their meaning as valuable pieces of information? And this is a big problem for the Fed because, they're looking at interest rates and credit spreads and inflation, unemployment as guides to policy without seeming to reflect on the fact that they're manipulating all those things. They're manipulating interest rates. So when you manipulate interest rates, you're going to manipulate inflation and, you're going to get particular results. You might be able to create some jobs by keeping interest rates artificially low, and you might be able to create some investment by doing the same thing. And so I guess I'm at the point where, again, do I pay attention to them? Yeah, and I'm appreciative of all the good work that people do along the lines you described. But I don't put that much weight on it because I feel that so much of the information is the result of manipulation that it really is not very valuable as information. And what I try to do is look at other metrics and use not equilibrium models or not regressions, but complexity model and Bayes' theorem and behavioral economics and some of the other tools in my personal toolkit. And you look at one financial cataclysm after another, and almost all of them can be attributed to the blunders in discretionary monetary policy. You don't want to point a finger at the Fed, but they do control the money, and these are monetary systems, and so you have to hold them to account. But of course, what happened in 1928, the U.S. was having enormous inflows of gold. Now, at the time, we were on a gold standard. Now, it didn't mean that there wasn't discretionary monetary policy. There was, and that's something that's not well understood. People think you have a hard and fast gold standard, a fixed money supply, and every dollar can be turned into a certain amount of gold at a fixed conversion ratio or vice versa. And that's what a gold standard is. And then when you get to monetary policy, we get to fiat money without a gold standard. It's just the Federal Reserve, and they print money, and sometimes they reduce the money supply, and that's that. They act as if those two things can't coexist, but they can coexist, and they did coexist through most of the 20th century. And in fact, most so-called gold standards are really just a ratio of paper money to gold. And you don't walk around with big bags of gold coins. You walk around with, paper currency or bank deposits. But what makes it a gold standard is that that you can convert it to gold at a fixed ratio. You don't have to worry about the money devaluing and being, worth less and less in terms of gold. You've got a fixed gold ratio behind it, and the money's always going to be worth a certain amount. Well, in order for that to work, to have a discretionary monetary policy and a gold standard at the same time, which is what we had in the 1920s, 1930s, you need to pay attention to gold. You need to use gold as a market signal to tell you if your policy is too tight or too loose. And then you're supposed to adjust the policy accordingly. And what was happening in the late 1920s is the U.S. was having gold inflows. That meant that the Fed could increase the money supply. And the law at the time, actually was the law all the way through until 1968, was that money supply could be 2.5 times the amount of gold. So you would take the amount of physical gold that the Fed had at a fixed price, multiply by 2.5, And then that's how big the money supply could be. And it could not be more than that. There was a ceiling on it. But in fact, during the Great Depression, it never got above 100%. The ceiling was 250%. It never got close to that. But in 1928, the Fed should have pursued an easier monetary policy. And it was with gold inflows. That meant you should engage in monetary ease, actually try to create some inflation, make the US prices a little bit higher. That would improve the terms of trade for our trading partners. Then the gold would turn around and it would start to leave the United States and go back to our trading partners because their prices would be less expensive. Our prices would be higher. And then, the gold would flow out, then it would flow back in again. That was something more like an equilibrium system, almost like the way the tide, flows in and flows out. That's how gold was supposed to flow in and flow out. But your monetary policy was supposed to be in sync with that. And gold was just a signal telling you, well, that's not what the Fed did. The Fed tightened. And the reason they tightened is they were worried about stock market bubbles. And when we all heard about the roaring 20s and the stock market was a bubble at the time. So the Fed kind of ignored their prime mandate, which is to pay attention to what gold was saying, took it upon themselves to pop a bubble. And doing so, they popped it so hard that they caused the stock market panic in 1929, which led to the Great Depression. So that was a blunder on the part of the Fed. And we'll come all the way forward to 2007, 2008, also 2000. You had the same thing. Greenspan talked about this in the 1990s with his famous 1996. He talked about irrational exuberance in the stock market. And he said that in 96, and then the market more than doubled between 96 and 99 before it finally popped in 2000. And then, of course, it popped again in 2008. But the point I make in the book is that not all these bubbles that pop are the same. There's an important difference, which is the bubble created by enthusiasm and overvaluation of stock prices themselves? Or is the bubble created by credit? And that's a big difference because what was happening in 1928 and what happened in 2000 when the dot-com bubble burst. Remember in 2000, the NASDAQ dropped 80%. 80%. It went from the kind of 5,000 level down to around the 2,000 level. That was a massive stock market crash, but there was no panic. If you happen to buy, pets.com at $200 a share, you probably got wiped out. And that's no fun for the individual. But it was not a market panic. It didn't spread around the world. It didn't spread to other markets the way things did in 2008. It was just a bubble popping. That's an example of a bubble not driven by credit. It was just driven by, irrational exuberance and overvaluation and speculation. What happened in 2008 was driven by credit. It was easy money in the mortgage market, no money down, no documents, no background checks, no doc, low doc, subprime, all-day mortgage loans. Anybody could get one. That was a credit bubble. And when that popped, that does cause contagion. That does spread through the banking system. That does cause bank collapse. It does cause a liquidity crisis. It's a very different dynamic. The problem is Janet Yellen doesn't seem to get the difference. She doesn't seem to understand the difference between credit-driven bubbles and let's call it, speculative bubbles. And there's always a little speculation in the credit-driven bubbles, but that's really the danger. And so she's afraid to pop the bubble we have right now. She's looking at the Greenspan model of 2000 and saying, Greenspan was right. He let the thing go and then it popped, but it wasn't the end of the world. So I'm not going to worry about asset prices. But she's missing the fact that the bubble going on now is credit-driven. It doesn't look like the 2000 bubble. It looks like the 2008 bubble. And that blind spot on her part is extremely dangerous.